After studying this module, you shall be able to get an overview of the investment decision process, which is called the capital budgeting process, and grasp the manner in which risk and uncertainty can be incorporated into the decision making process. Introduction. Generally, decisions regarding the optimal levels of production, consumption or factor input employment are taken by comparing the current expenditures and the current revenues or marginal products. This is acceptable with inputs like labor, where one has to decide on the level of employment of labor in view of the current wages and the current marginal revenue products. However, with the factor input capital, the decision making process, while being the same, has to be based on a different set of data. Capital expenditure is typically expenditure on plant and machinery, wherein the current level of expenditure has to be compared with the revenues that will be generated in the future. Therefore, we require a method to bring the future revenue down to the present revenue to enable us to compare it with the current expenditure. While considering future revenues, the various kinds of risk and uncertainties should be allowed for. Therefore, we also focus on how the aspects of risk and uncertainty can be incorporated into evaluation techniques and thereby the decision making process. Now, let us first look at what is capital budgeting process. Now, capital budgeting process is the process of planning the capital expenditure after a careful evaluation of the available capital expenditure alternatives. Optimality requires that firm should undertake additional capital expenditure projects as long as the marginal returns from the project exceeds their marginal cost. This is shown in figure 3.1. As we see in the figure, the vertical bars are the different capital expenditure projects arranged in descending order of returns. The curve sloping upwards is the marginal cost curve. That it is rising shows the rising cost of raising additional amounts of capital by the firm. The firm should undertake these projects, the returns from which exceed the marginal cost of capital. In the figure, it corresponds to the first three projects. So, the above model can be divided into 4 stages. The first is generation of capital investment projects. Second is estimation of the cash flows. Third, evaluation of investment projects. And fourth, ex post evaluation of projects. Now, let us look at the first one, that is generation of capital investment projects. Idea generation is the first step towards the generation of capital investment projects. Ideas or proposals can be generated at all levels of the organization. Replacement projects involve replacements of old and worn out pieces of machinery. Projects can also reduce cost, such as labor saving equipment and machinery for technologically new processes to reduce cost by replacing obsolete machinery. The demand for increased capital outlays may come from market expansion. A market expansion plan has to be backed by an adequate production expansion plan, which essentially means capital outlays for capacity expansion. Diversification into new products also calls for capital investment projects. Estimation of the cash flows. Now, estimating the cash flow involves estimating cash outflows and inflows over the life of a project. Since it involves projecting cash flows into the future, it is ridden with uncertainties. Now let us assume that the decision maker can project these cash flows with certainty. There are certain guidelines that must be borne in mind while estimating the cash flow. The first principle is that the cash flow has to be measured on an incremental basis. This means that the relevant cash flow is the difference between the cash flow that existed before the project and the cash flow with the start of the project. The second principle is that the cash flow should be post-tax flow. The third principle is that it should consider both direct and the indirect effects of the project in its cost and benefits stream. Now, if capital investment of one division of a firm is going to help reduce cost of other divisions also, these reductions have to be considered in the cash flow of the project. Now, according to the fourth principle, all sunk costs are to be ignored. Sunk costs are those costs that are incurred in the past or have been committed to and cannot be withdrawn under any circumstance. The fifth principle is that the resources employed in the project should be valued at their opportunity cost, that is, at what has been foregone. Now, for a capital expenditure project, there will be an initial investment at t equal to 0, which will generate a cash flow stream in the future. Now, this initial investment is a cash outflow and the revenue streams from time period onwards are cash inflows. There would also be cash outflows during the life of the project and not just at t equal to 0. The post-tax incremental net cash flow, that is NCF, is equal to the difference between cash inflows and cash outflows. Now, depreciation being a non-cash charge is added back to get the correct estimate of the cash flow. Now, let's look at the evaluation of the investment projects. Now, after identifying a capital investment project and its cash outflows, now we have the data required to evaluate the project, that is to see whether the project is economically viable and whether it satisfies the marginal rule. Now, there are several methods of evaluating a project. These are as follows: A. Payback period, B. Average return on investment or the accounting rate of return, C. Net present value, and D. Yield on investment or the internal rate of return. Now, let's look at each one of them in more detail. Payback period. Now, this measure gives the time period required to recover the initial capital outlay from the cash inflows. The period over which the sum of the cash inflows equals the initial capital outlay is called the payback period. The smaller the payback period, the more desirable is the project. Now, second is accounting rate of return. This method relates income to investment. It is defined as the ratio of net average annual income from the project to its initial investment. Net average annual income is equal to the net income divided by life of the project in years. And net income is the difference between net cash inflows generated by the project over its life and the net cash outflow of the initial capital. Now, what is net present value? Now, the net present value method compares the cash inflow generated with the initial investment. Now, if the sum of discounted cash inflows received over the life of the project exceeds the initial capital outlay, the project is considered to be economically viable. That is, if the NPV, that is net present value, is positive, the project is considered worthwhile. Thus, NPV is equal to minus C plus P1 upon 1 plus R plus P2 upon 1 plus R square plus so on to Pn upon 1 plus R to the power n. This can be written as summation Pt upon 1 plus R to the power t minus C, where C is the initial capital inflow and hence it is negative, and P1 to Pn are the cash inflows occurring in the time periods 1 to n, and R is the discount rate. The NPV is a function of the discount rate R. Now, for the same project with higher discount rates, the NPV reduces and becomes negative, while at lower discount rates, the NPV may be positive. Thus, a project which is rejected with one discount rate may be accepted with another discount rate, thereby making the choice of the discount rate an extremely critical input. Now, let us look at the internal rate of return method. Now, in this method, a discount rate is found so that the NPV at that discount rate is 0. Now, this discount rate, which equates the initial capital investment to the present value of net cash inflows over the life of the project, making the NPV 0, is called the internal rate of return or IRR. It is the value of R in the following equation, that is C is equal to summation Pt upon 1 plus R to the power t. Here C is the initial capital investment, Pt is the net cash inflow in the time period t, where t ranges from 1 to n, and n is the life of the project. Now, ex post evaluation of projects. At this stage, the quality of the estimates is tested by comparing it with the actual cash flows. The smaller the deviation between estimates and actual, the better is the quality of the estimates. This feedback on the estimation procedures is an extremely important piece of input for future capital investment decisions. Now, let us study the decision making under risk and uncertainty. Now, what are the risk adjustments in decision making? A decision making situation in which the possible outcomes can vary and the probability of the occurrence of each outcome is known, that is said to be a risky situation. Risks are of two kinds, diversifiable and non-diversifiable. Diversifiable risks can be removed by investing in many projects. However, non-diversifiable risks cannot be removed through diversification. The possibility of a recession in the economy is a non-diversifiable risk for a firm. Now, there are various methods of incorporating risk into the decision making process. One is the subjective approach. In this case, the decision maker assesses the risk subjectively. Now, when faced with a situation where the net returns of two exclusive projects are the same, the decision maker makes a subjective assessment of the risk involved and chooses the one where the risk is low. Now, however, where both returns and risk are unequal, decision making is more difficult, but risk is still assessed subjectively. Now, in the utility function approach, the individual maximizes the expected utility. This assumes that the individual is able to attach a level of utility to each of the possible outcomes of a decision. That is, EU is equal to summation UI into PI, where UI is the utility of the ith outcome and PI is the probability of occurrence of that outcome. This EU is compared with EU of another decision, and the decision maker will choose the one with higher EU, and EU equal to 0 indicates indifference. Now, in the risk adjusted discount rate approach, a risk premium is added to the risk free discount rate. Where the risk is diversifiable, the discount rate will be the risk free interest rate. However, where the risk is non-diversifiable, a premium is added to the discount rate. With a risk adjusted discount rate, the NPV is equal to sigma PT divided by 1 plus k to the power t minus c, where PT is the net cash flow at time t, k is the risk adjusted discount rate, and c is the initial capital outflow. Now, let us look at the decision making under uncertainty. Now, what is uncertainty? Uncertainty is a situation where the decision maker does not know the probability of an outcome. In such situations, there are some decision rules that the decision maker can use, provided he can identify the possible outcomes and the payoffs associated with each other. One such criteria is max-min criteria. In this, the decision maker, faced with the payoffs of the various outcomes of the strategy, chooses the best amongst the worst possible outcomes. So, in this criteria, decision maker examines the minimum payoff that would result from each solution alternative and then selects the one with the maximum of the minimum payoff. Now, let us take an example to illustrate this. Consider the case of a manufacturer of laptops who is faced with the problem of selecting one of the two models to be manufactured. The profit depends on the market acceptability of the model, which at present is uncertain, but it has been broadly classified into 4 categories: excellent, good, fair and poor. Similarly, we have profits for the case where market acceptability is good, fair and poor. Now, the question arises, which model should the company select? It should be noted that the probability of the market acceptability being excellent, good, fair or poor is not given. So, this implies that it is a case of decision making under uncertainty. Now, using the max-min criteria, we will first calculate the minimum payoffs for each of the model. Now, as is evident from the above table, in the worst scenario, model A can give a profit of rupees 8,000 and model B will give a loss of rupees 12,000. Based on the max-min criteria, the maximum of the minimum, that is 8,000, or model A will be selected. Therefore, the company will select model A. Now, let us look at the other criteria, which is called the minimax regret criteria. This criteria enables the decision maker to select the investment project that minimizes the maximum regret. Regret represents opportunity loss, that is the opportunity to obtain a higher payoff if another strategy has been selected. It is measured as a difference between the payoff of the best strategy under each state of nature. Now, this criteria can be illustrated using the following example. Now, suppose there are 5 strategies to buy 100, 200, 300, 400 and 500 trees, and there are 5 states of nature which represents the sales of trees, that is N1, N2, N3, N4 and N5. N1 is the case where 100 trees are sold, N2 is the case where 200 trees are sold and so on. If we had the probability of each state, then we could have calculated the expected value of each state and chosen the maximum expected value. However, since the probabilities are not available, this is a case of decision making under uncertainty. Now each of the values in the matrix represent the payoffs of the combination of strategies and states of nature. Like for example, 1500 is the payoff if 100 trees are bought and sold, and so on. Now regret corresponds to a particular state of nature, because for each state of nature there are multiple strategies, and depending on the strategy that the decision maker chooses, the regret may vary. Now for the state of nature N1, the highest payoff is 1500. So ideally strategy S1 should be chosen. Now considering that S1 is not chosen, so then what would be the regret for each strategy for N1? So for S1 N1 combination, the regret would be 0, that is 1500 minus 1500. For S2 N1, the regret would be 2500, that is 1500 minus 1000. Similarly, regrets can be calculated for different strategies for each state of nature. The idea here with the minimax regret criteria is to choose a strategy which even in the worst case scenario would give the minimum regrets. Now besides the above explained criteria, now let's study more how to manage the risk and uncertainty. So there are many other ways of reducing risk and uncertainty. One is seeking more information. Now in many situations the uncertainty can be reduced by seeking out more information. For example, if the investment was towards the development and launch of a new product, the uncertainty regarding the success or failure of the product launch can to a great extent be removed by launching a trial version of the product in a representative market. Now second option is diversification. Now where the risk is diversifiable, investors invest in several diverse assets with differing levels of risk, so that on an average the risk is evened out. So diversification can be undertaken at the level of both the stockholders and the firm. At the level of stockholders, it happens when individuals, in order to diversify the risk, invest in a portfolio of assets. At the level of the firm, a firm acquires a wide range of firms in unrelated industries, the rationale being that these acquisitions would reduce the inherent cyclical risk of the industry to which the acquiring firm belongs. Whereas at the firm level, such kinds of diversifications are costly. They are much more easily managed at the stockholders level with no premium attached. Another option is hedging. Now this is a strategy to reduce the risk, wherein the investor takes off setting positions in the ownership of an asset through instruments called derivatives. An investor often uses buying or selling of a future contract to offset risk in the cash market. These contracts are legal obligations to buy or sell goods specified in the contract at the price agreed upon at some point of time in the future. Now this shields the investor against price fluctuations in the future. Purchasing insurance is another option. It involves paying a premium to protect against different kinds of risk like accident, fire, death, etc. Insurance is commonly available for losses due to fires, accidents, thefts and fraud. Now whether insurance is required or not depends on the degree of risk averseness of the buyer, his assessment of the severity of the consequences of the event occurring and the premium itself. Then we also have the restricted use of firm specific assets as an option. Here setting up a production center that necessitates the use of a firm specific asset ties down the producer. Firm specific assets do not have general purpose uses, and so in the event of a closure, resale of these assets is not easy. Since firm specific investments offer few, if any, options for diverse use, investors should opt for these investments only after a thorough evaluation. Now we can summarize over whatever has been studied in this module. The evaluation of a capital investment project requires a comparison of current expenditures with revenues that are expected to accrue in the future. Capital budgeting is the process of planning for capital expenditure based on a careful evaluation of the alternatives. The 4 stages in the capital budgeting process include generation of alternative investment projects, estimation of cash flows, evaluation of projects, and ex post evaluation of projects. Now, risk is when there are several possible outcomes and the probability of their occurrence is known. As against this, an uncertain situation is one where the possible outcomes are many with unknown probabilities. The risk is adjusted for subjectively through a utility function or risk adjusted discount rate approach. But in an uncertain situation, 2 criteria are primarily used. One is the maximin criteria and the other is the minimax regret criteria. Risk and uncertainty in situations are mitigated to a great extent by seeking more information through diversification at the stockholder level and at the firm level and through hedging and insurance.